Ladies and gentlemen, good day and welcome to Arman Financial Services Limited 2Q and H1FY23 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, sir.
Yeah, thank you, Aman, and good evening, everyone. On behalf of InCred Equities, I welcome you all to Arman Financial Services Limited 2Q and H1FY23 earnings conference call. We have along with us Mr. Jayendrabhai Patel, Vice Chairman and Managing Director, Mr. Alok Patel, Joint Managing Director, and Mr. Vivek Modi, Group CFO. We are thankful to the management for allowing us this opportunity. I would now like to hand it over to Mr. Jayendrabhai Patel, Vice Chairman and Managing Director of Arman Financial Services Limited, for his opening remarks. Over to you, sir.
Thank you, Jignesh. On behalf of Arman Financial Services Limited, I extend a warm welcome to our Q2 and H1 FY23 earnings conference call. With me, I have Alok Patel, Joint Managing Director, and Vivek Modi, Group CFO. We have also on the call representatives from SGA, the Investor Relation team. I hope everyone has an opportunity to go through the results and presentation for the quarter and half year ended September 30, 2022, which was uploaded on the stock exchanges and the company website. In the past 2 years, microfinance sector has successfully navigated the pandemic and is back on the track, showing healthy demand. Additionally, the Reserve Bank of India's new guidelines is expected to help the industry grow even faster. During the H1 FY23, the industry was focused on adapting these new norms, on account of which the loan disbursement was slightly subdued. However, the microfinance business has emerged as one of the important tools for promoting financial inclusion and serves as the last mile of credit to those at the bottom of the pyramid. And at Arman, we are focused on serving the low-income, underserved regions of the nation, promoting livelihoods and offering microcredit to socio-economically backward people who have little to no access to the formal banking or financial services system. At present, we have a presence in 8 states with comprehensive branch network of 313 and a workforce of 2,620. Of all the states, Gujarat contributes 31.9% to our AUM on a consolidated basis, followed by Uttar Pradesh, Madhya Pradesh, Maharashtra, and Rajasthan. Company has recently forayed in 2 new states of Bihar and Haryana. We will continue to focus on extending our presence in newer districts in existing states while also exploring new states. On consolidated basis, gross NPA stood at 3.3% and net NPA stood at 0.1%, showing an improvement of 230 BPS and 100 BPS respectively on account of improvements in collection efforts and lower provisioning. Cumulative provisions stood at INR 70 crore, that is 4.9% of the consolidated AUM and 5.2% on book POS, portfolio outstanding. Therefore, total provisions remain much higher than GNPA. Collection efficiency improved to 98.3% in October 2022 as compared to 95.3% in March 2022. Collection efficiency across all segments has shown improvement and aligned with the pre-COVID levels. This was mainly due to the passionate on-ground workforce, continuous customer interactions, and a customer-focused approach. Collection efficiency for October 2022 for various segments stood as follows: Microfinance segment 98.4%, MSME segments 98.1%, two-wheeler collection 96.7%. Now, coming to the borrowing profile and liquidity. As on 30th September 2022, company has total borrowings worth INR 1,419 crore. Of the total borrowings, 53.8% is through banks and NBFCs, 21.7% is through securitization and PTC route, and 14.1% is through NCDs, and the rest is borrowed through DFIs, ECBs, and direct assignments. I am happy to share that during the quarter, company successfully raised INR 115 crore via allotment of CCDs and OCRPS on a preferential basis. The arrangement stands as follows. Company has allotted 6,24,388 unsecured compulsory convertible debentures, or what you call CCDs, amounting to INR 77 crore. Some of the marquee investors include funds controlled by Singapore-based 16th Street Capital and USA-based 7 Kenyans Advisors. Other investors include both domestic and foreign individuals. Company has also allotted 3,10,972 optionally convertible redeemable preference shares, or you can call them OCRPS, amounting to INR 38 crore. These were allotted to individual investors and family offices. The mix of Tier 1 and 2 equity capital will be used to fund the targeted growth plans of approximately INR 2,500 crore, with a healthy capital adequacy and a debt equity ratio by leveraging our presence in the MFI, MSME, two-wheeler, and other loan segments, which will enable the company to achieve a sustainable growth momentum in the coming few quarters. As per IND AS, company is required to split hybrid instruments into debt and equity, and therefore the company's balance sheet net worth stood at INR 311 crore. However, fully diluted net worth, assuming full conversion, stands at INR 362 crores. Also, we have a healthy liquidity position with INR 376 crore in cash, bank balance, liquid investments, and undrawn CC limits. Capital adequacy for Arman on stand-alone basis stands at 51.21%. I repeat, 51.21%, and for Namra, our subsidiary, stands at 20.51%. With the equity fund raised and new LMS system, we will steer the next phase of our growth and expansion by harnessing the power of technology and innovations to create a smarter organization that will enhance customer experience. We will grow this business at a careful but steady pace by spreading out across states, building necessary capabilities, and adding relevant resources. With that, I would like to request the operator to open the floor for any questions and answer session. Thank you all so much for joining. Thank you. Operator?
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is on the line of Virat from Shah Investments. Please go ahead.
Hi, sir. Sir, what kind of AUM and disbursement growth are we targeting for FY23? Any comments on that?
No comments on that. Typically, we try to grow between 35 to 40% CAGR over the long run. So it will be somewhere in line with that. But on projected results for FY for next year.
Okay. Sir, and how do we plan to utilize the fundraise of rupees 115 crores?
So as you know, in an NBFC, there are regulated ratios to maintain, namely the capital adequacy ratio, and we were approaching close to that, and hence was required for us to raise this excess capital. And the funds will be used just for onward lending, and to leverage on top of that to increase our AUMs.
Okay. Thank you.
Thanks.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Anjana from Shah Investments. Please go ahead.
Thank you for this opportunity, sir. A couple of questions from my end. So the first one, I would just want to know if you could throw some light on the reduction of our MFI book. So, we plan to reduce our MFI book to some 60% of AUM. Could you elaborate on the same?
We plan to reduce our MFI book by 60%.
No, to 60% of AUM.
To 60% of AUM.
You're talking of the pie in a sense from something like 80% to brought down to 60%. Are you trying to say that?
Right, sir. Yes, that's right.
No, there is a long-term plan to diversify the product line into other ancillary products like micro enterprise that we have, which is about 40% of we have also, have individual business loans, which is 2%. Two-wheeler loans is 4%. So the long-term goal is to, get more into micro ancillary products rather than the JLG product. But we still very much plan to be in the micro retail segment serving the rural customers. But I think that is what you are referring to. Overall, time goes on, I think more and more, the microfinance segment has been showing extremely good growth in the past 10 to 12 years. And going forward, we expect it to continue growing at least for another 3 to 5 years. Post that, there'll be the expectation is that the other products such as micro enterprise and individual business loans will start showing more growth than the JLG-based group loans. Now, these are estimates, of course. The market forces will behave as they behave down the future, but that is our expectation.
Sure. So also, how do we see our two-wheeler and MSME business panning out?
They are doing we'll take one at a time. So MSME is doing extremely well. I think over COVID, it has performed really well as well. But it takes a very specific kind of customer. And if you are comparing, let's say, a growth rate between group-based unsecured JLG lending versus, the micro enterprise with much higher underwriting and everything, It's not very, very comparable. So the growth rates might be a little dwarfed by the rate of what microfinance is growing, but still MSME stands on its own and is an extremely good and extremely profitable segment that we are running. Now, as far as two-wheeler is concerned, that industry has been in the doldrums since COVID and even before that. I think if you look at the amount of vehicles sold in 2019 at somewhere around 21 million to somewhere around 13 million in the last 12 months, overall the volumes of two-wheeler sales have declined drastically over the last 3 odd years. So we have not completely discounted two-wheeler. It's hanging in there. But there are tough times in the past and probably tough times in the future as well for the two-wheeler segment.
Sure, sir. Understood. Sir, we've started dispersing loans under IDL segment. How do you see this panning out in coming quarter?
So coming quarter, maybe it's too early to tell, but in the coming couple of years, the idea is that a lot of these microfinance customers who have been with the company for several years, 5 to 6 years, and have been microfinance customers for 10 to 15 years even in many cases, they rightfully so, there is a requirement that we graduate them away from these group-based loans into individual loans. And the natural progression and evolution also is to get away from cash-based collection into cashless collection. So that is the goal overall. And I think it will take a couple of years to gain good traction in this industry. But we are planting seeds right now as far as, diversing away from pure GLG-based, group-based microfinance.
Understood. But then, sir, with these IDL loans, do we foresee any risk-based pricing model coming in play, which was not possible under JLG?
Risk in terms of what you said? Pricing risk. So,
yes,
in
sir.
terms of
Risk-based pricing model, basically.
No, I mean, lot of these customers have been with us and have an amazing track record even during COVID. So I consider these customers to be, very, very safe. And let me also tell you that the repayment rate in this segment, although it's only 2% of the book, the repayment rate is 100%. We don't have 1 rupee in overdue or default in this segment so far. It's a little early to celebrate, but we consider this as very low-risk customers. Vivek, you were adding anything?
Yeah. So, largely, at this stage, these are basically our own set of customers who probably are dropping out of JLG, and hence, it's about retaining the best-in-class customers with you through a product innovation. Over a longer period, since these would become kind of a full banking kind of customers, we might also kind of graduate over a period of time to a larger ticket size loans which could be there. But those are like things in the future. At this point of time, it is more about retaining our quality customers with a IBL kind of a.
Absolutely. So a lot of the studies that we were doing on our retention levels, we saw many of these customers kind of leaving after 3 or 4 cycles with us. And the question was why? And the answer was that they were going for individual-based loans from banks or SFBs. And these were our cream customers, so why should we lose them? We can service them just as well as any other bank can.
Got it, sir. Thank you. That was really helpful.
Thank you. The next question is from the line of Savi Jain from 2.2 Capital. Please go ahead.
Hello.
Yes, Savi, go ahead.
Yeah, you mentioned that there were some liquidity challenges during the quarter. Has that normalized now this quarter?
Yes, it's completely normalized. In fact, we are facing a reverse issue. See, largely speaking, as we were approaching our CAR ratio, obviously, most banks do not wait for your debt equity or capital adequacy to go down to 15. So that was one challenge. Macroeconomics was another challenge. And frankly, we have not faced liquidity issues in our, at least for the last 10, 12 years. But yes, for a month and a half, we did face some issues that has been largely solved thanks to the recent fundraise. And it also gave us some time, fortunately, to transfer and transition into our new LOS and LMS system. So all in all, we made good use of it as well.
Okay. This CCD and everything, for the rating agencies, do they consider that as equity or?
CCD is considered as pure equity, is a tier 1 equity, because it's compulsory convertible. In case of OCRPS, it's a tier 2 equity until converted, because it's an optionally convertible, or you can redeem it as well. But yes, CCDs is considered as pure equity, and OCRPS is tier 2 equity. So it's like a hybrid debt.
So they will at least use the CCD they will include CCD they'll give the benefit of CCDs for your rating improvement as in their calculation.
Absolutely. And some portion of OCRPS as well, because there are multiple investors. And I think if you look at the balance sheet, and as Jayendra Bhai said in his speech also, under Ind AS, hybrid debt instruments have to be split between debt and equity. So the net worth you'll be seeing is around 311 crores. While fully diluted net worth, if you consider everything converting, today would be 363 crores or something like that. So already there is a discount given because of the hybrid nature of these instruments in the net worth of the balance sheet under Ind AS itself.
And this individual loan that you were talking about, isn't the same as MSME? What is the difference there?
Similar, but the clientele is slightly different. So on one side, in the MSME side, we are finding cash customers, and it's a cash-based collection. On the individual business loan side, which are graduated microfinance customers, so the underwriting might not be as stringent because we have, 3, 4, 5 years of experience with them. But we have switched them to a cashless collection model. So as I said, Savi, we are planting seeds. Yes, there are some similarities for sure between the products, especially as far as ticket sizes are concerned on average. But the sourcing is different, and the repayment, the collection methodology is different.
In these MSME loans, which you're doing, this is this similar to what Five Star is doing, but lower ticket size? Is that the right way to look at it?
I'm not sure what Five Star actually does. Five Star average ticket size is somewhere around 5-6 lakhs, if I'm not mistaken.
Yeah, lower. But yeah, only difference is they do secured, you do unsecured. Your yields are obviously higher than theirs. But is it a logical progression for you to move into higher ticket size and maybe secured? Is that possible for you?
Yes, absolutely. It's worth considering. The models are different, and I don't know Five Star's model, but largely speaking, it's a secured asset which is difficult to repossess. with the limited amount of research I've done into it. Of course, there is a sentimental value of having your residence or your house mortgaged, but in case of a default, very difficult to repossess these assets. So that is at least my, and I don't think that's a very big secret.
No, that's true. That's true. Even Equitas says the same thing about the SBL customer. But I think the difference on the credit cost is pretty, for an unsecured loan versus a secured loan, even though it may not be technically, possible to repossess, but I guess the credit costs are much lower just because of that fact that they're kind of mortgage their house.
You are absolutely correct. And we have discussed this both at a board level and individually as well. It might be something which is a natural progression for us. And let's see. I think certainly I'm not going to discount it as a viable division in the future.
I think the only difference is that the GDP per capita in your state is much lower than the southern states, and I think that makes it more difficult to do it in north or in the rest of the country as compared to south of India.
The difficulty also lies in the fact of the paperwork and the legal work involved, especially if you talk about the rural areas. Primarily mortgaging in the rural areas at least is very difficult because the paperwork is very weak.
Provisioning with respect to COVID, is that over in this quarter, no?
Yeah, everything pre-COVID, which is assets dispersed prior to March 2020 is done and dusted, written off or provided for. So that's over with. So that's... Yeah.
But the provisioning still seems a little high. Is it because you're providing the standard asset provisioning has increased?
The asset size has increased, the standard asset has increased, and also the fact that, microfinance is no longer under the 1% loan loss regime. You'll have to expect a couple of percent. So we are monitoring that closely. And thanks to the RBI regulations also, to a certain extent, it has been passed on to the customers as well through margin increases and rate increases. But yes, I think a lot of it is related to post-COVID NPAs as well.
So what is the standard asset provisioning percentage that you are now using?
I mean, we are under ECL provisioning. So our provisioning is 5.2% and NPA is 3.2%. So in a layman's term, you can call it 2% if you like.
On the standard assets.
On the standard assets.
That's higher than what it was pre-COVID.
Yes.
Yeah, it is definitely, it's definitely higher than the pre-COVID. Again, the reasons for it being slightly higher is also the fact that there are pre-COVID book which were restructured and are in standard buckets, continue to have a bit of higher provisioning, but they continue to be in standard buckets. So from that aspect also there is there. And overall, the management overlay that has been created during the COVID phase will be there for some time till it kind of tapers off and we relook at the entire ECL model based on the overall experience the last 5 years and kind of redo the requirements.
I think as our auditor told us, there are no black swans in ECL, no black or no white swans, only history.
So why is it that we have released provisions in the standalone numbers?
Mostly write-backs. So a lot of these are write-backs in the standalone side.
Got it. So growth, you don't have a number for this year? Do you have a number for this year and next FY24?
Unfortunately, I wouldn't want to comment on the growth numbers this time. But maybe I have a better idea for you.
Thank you. Mr. Jain requested to join the question queue for any follow-ups. Also, participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-ups. Thank you. We have the next question from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi, hello. Good evening.
Good evening.
Yeah. Am I audible? Yeah, sure. Just want to find out from a NIM perspective, has the new regulation kind of fully kicked in, or do we need to wait for a couple of more quarters for the old book to kind of get flushed out and the whole repricing? Are we likely to see some more NIM accretion over the next couple of quarters?
Yes, I don't know. So I think it will take a few more quarters. Vivek, I don't have that number of what % of the book is new regime versus old regime. So, but it will be a significant weightage at this point.
So at this point of time, probably we don't have a specific number to share with you, but by a simple back of the palm kind of a calculation, at least 60% still continues to be old regime, because we were at about 1,100 crores in microfinance when the regime changed. And right now, if we are 1,200 crores, so
you count 90 crores of repayment as well.
So by that logic, largely, it will be a split of 50 on that. But since the average balance tenure of the loans as on, say, March 2022 would have been approximately 15 to 18 months. So, it will take some time when it kind of completely wanes off.
As far as your NIM question goes, see, our cost of borrowing has been going up significantly also since because of the repo changes and stuff. So while we do expect NIMs to increase in the future, it will not be to such a large extent, because it will be offset by some bit of absorption in the cost of borrowings.
Got it. Okay, got it. Uptrending NIMs, but the larger part of the NIM accretion has already taken place in the last 2 quarters. Fair understanding. Is that a fair understanding?
No, I would disagree with that. I would say about half of it is done. Half of it remains.
Perfect, Alok. Perfect. Cool. Moving on, just want to understand, how have you faced any teething issues in implementing the new regulation? Of course, we have a significant edge given that we already do all of this in MSME, but from what I remember, those set of, employees are a grade or 2 higher when you hire them in first place. So, are you facing, how is the on-ground situation on income assessment and documenting it, and then, kind of figuring out that I can't remember again, 50% or there's some limit the government has given. So how is this whole process working on the ground, and, how do you see that improving over the next 6-8 months or 1 year and so on?
No, it's definitely a work in progress. I think overall, in April we had used our old system and kind of done a best effort job of evaluating. That is continuously improving, and it has improved significantly with our new software conversion as well, as far as inputting all the right kinds of information to assess income. Besides that, I think since we are capturing household indebtedness, as a result of that, rejection rates have also increased. And I think that message has been consistent with a lot of the other MFI players as well. So all in all, I think, the rejection rate has slightly increased because of this regulation.
Got it. pinching a last question before I go. Just I want to find out if you've opened any new geographies, any new micro markets, and if we have, made some progress on going into lower density areas because of the flexibility in pricing, and also have we disaggregated pricing because we have had very different credit cost experiences over the last couple of years in different micro markets and even from Demon to today. So are we looking at disaggregated yield structures in different markets based on your risk perception and so on?
Yes. So we have not done that yet. That is part of the plan in the long run, maybe starting from the fourth quarter or the first quarter, that geographic-based pricing or risk-based assessment pricing. Now, as far as the micro markets are concerned, no, I think the past couple of quarters have been challenging with a lot of different projects in our hands, with RBI implementation, with software implementation, with liquidity, capital raise and stuff. And obviously the growth that we are looking at, which is ongoing. But yes, that is something to consider. I think I can confidently more say about the differential pricing in geographies. As far as moving into these micro markets, we are never a first mover into any kind of a new situation. So that will be sort of slower. Let us see what the competition is doing and what their experiences are in some of these markets. Other than that, we recently moved into Bihar, planning to expand on that in the coming few months. And Bihar has been behaving wonderfully, so that has been a pretty decent foray into a new state.
Is this running out of your Uttar Pradesh team itself, or you now kind of have a completely new setup put in and so on?
It will run out of UP team until Q4. After that, we'll split it from Q1 next year.
Perfect. Thanks a lot, Alok, and congratulations for the great set of numbers.
Thank you.
Thank you. Next question is from the line of Yash Mandaviwala from Mandaviwala Family Office. Please go ahead.
Hi, Alok. Congratulations on a good set of numbers.
Thank you.
Alok, we've just, most of the FMCG companies seem to be complaining about, poor rural demand. Yet, most microfinance companies such as yourselves are reporting good collection efficiencies. So, what is really happening on the ground? How is there this, divergence of commentary on the same set of customers?
I mean, yes, I don't consider myself an expert on macro or microeconomics. All I can say is that we have not faced so much of a difficulty or so much of a feedback from our operations or field that people are facing any large-scale difficulties as far as economics are concerned or weak rural demand or anything is concerned. But maybe there is a lag effect. I don't know. But other than that, I wouldn't want to comment anything more on that.
Got it. Maybe let's wait and watch. Just one more on the new software system. So is the implementation now completely done? And I know it's early days, but where are you seeing sort of large differences, or where are you seeing significant value add from the new software?
No, so I mean already our TAT has reduced by about 30-40%. So that has been a big achievement. Overall, it was very successful and a lot of things had to go correctly. It is fully implemented now, and we are collecting large volumes of data. The risk controls has increased, skyrocketed overall with geotagging and everything. We are using digital signatures now. We have a tie-up with Legality. Become completely paperless. So it has a lot of different advantages. And yeah, I think overall it has already been a big success.
Do you think in the end it will lead to the, loan officer being able to handle a higher volume of customers?
It could, but I'm not exactly sure whether that should be the goal, because higher per person capacity also comes with its own set of risk when something goes wrong. So when the delinquencies and stuff rise, one person is not able to manage such a large caseload. And the group sizes also have been overall in the industry going slightly lower as years go by. But what it will help us in the future is moving more towards the cashless repayment. And in that case, yes, an FO will be able to handle more customers, but that will be a whole new model. Under the current model, I don't think that is our overall goal, is to increase the caseload per FO, although that might be an ancillary benefit down the road.
Got it. Thanks a lot, Alok. That's it from me.
Thanks.
Thank you. Our next question is from the line of Balkrishna Vagasia from Axon Investment Managers. Please go ahead.
Good evening, team. Many congratulations for the great quarter.
Thank you.
So, I want to know what is the average turnaround time, customer turnaround time for microfinance and MSME business?
So for microfinance, it goes state by state. I have the figures. I think it's approximately 4.6 days, the last I checked.
For microfinance?
3 days is the customary or the regulatory training that we have.
Yeah, so it cannot be less than 3 days. And pre the software, it was at least 6 to 7 days. So we have brought it down to that much. In MSME, we have brought it down from 12 days to about 8 days, but there is still a lot of room for improvement there.
Okay. And what is the branch expansion plan for the second half?
So what is the plan is to open about between 15 to 20 branches. For Q4, we are still working on that, so you'll have to wait on that question for the next quarter's call.
So 15 to 20 branches in Q3.
Correct.
Largely more like for the FY24.
Right.
So normally we've kind of seen larger branch expansion happening in the fourth quarter and the first quarter of the next year.
Exactly. So when we do our planning for FY24, so a lot of the branch openings will happen in, February, March, April, May time frame. But we don't expect a lot of business to come out of those in the current FY.
Okay. All right. So, in terms of the average lending rate, that before the new regulation and the post the new regulation, what is the change in average lending rate in microfinance that you have observed in your loan book?
About 2.5% has been the increase.
2.5%. Okay. And in terms of MSME segment, so 2-3 years back or 3 or maybe 4 years back when you started MSME segment, you say that, okay, I do the experiment initially, and then if I am satisfied about the scalability of the particular business, then we go with full force. So, are you satisfied with the MSME segment and you want to go on full throttle on this? Or what do you think? Or do you want to scale this business now?
We are very satisfied with MSME, and it's no longer an experiment. It is definitely a full-blown division. But as I answered the first question, I'll kind of give you the same answer is that we are growing and we are growing well, but it requires a specific type of customer. In the MSME, the rejection rate is still about 70% in that division. So if you are going to compare apples to apples in terms of growth rate for compared to micro and MSME, my lesson learned is it's not going to be very comparable. But we are still growing at good 20-25%, 20% of that.
On a YOY basis, what happens is, obviously, FY22, September, we had just come out of the second wave of COVID. But still, if we use September 21 as a benchmark for both microfinance and MSME, I think MSME, again, in our case, has grown to almost 60% from something like 125 CR as of September 21 to about almost 200 crores as of today. September 22. So I think MSME has been showing good growth generally and can see good times going forward as well.
Okay. And which segment among all of yours, like microfinance, MSME, individual loan, and vehicle finance, so which is the most profitable for you, including the effect of NPAs as well?
No, definitely, if you compare just the bottom line margins, MSME is the most profitable, followed by microfinance and followed by two-wheeler. But I mean, these are I don't want to say very different businesses. They are not very, very different businesses, but these are different businesses. On one hand, you have a better growth potential. On the other hand, you have a better margins. So we try to take the best of both worlds and do both the businesses.
Okay. And last question. For microfinance, how many of your customers are unique to you?
So that is, I always give a disclaimer to that question. Unique to me only applies to when I'm pulling the credit bureau report and I find it as no other financial institution where they have an active loan with. So that is approximately 25%. But after I loan them the money, if they borrow from somebody else, I have no track of that.
Yeah, that's for. And what is the cycle-wise classification of the borrowers, like first cycle, second cycle in microfinance?
Vivek, you have that. So about 65% is first cycle customers, and 65 to about 68% is first cycle. Rest of it is second cycle and above. Exact breakout, unfortunately, I'll have to pull it out. I mean, I have an idea, but I don't want to give you wrong numbers.
That's all from my side. Thank you so much.
Thank you. The next question is from the line of Amit Mantri from 2.2 Capital. Please go ahead.
Yeah, hi, Alok. First, congratulations on the good performance.
Thank you.
Yeah, so I just wanted to understand, so in the MFI book, what has been now the number on what percentage of the March 2020 book went bad? So on a static pool basis, what was the credit cost of the MFI book?
10 to 12%.
Okay, thanks. So basically post COVID, which is FY21 and FY22 disbursals, there you didn't really have any significant credit costs, is it?
Not yet, but we are expecting somewhere around 2% on post-COVID on an ongoing basis.
Okay, got it. And the second question, now the book is almost close to 1,500 crores, and you eventually in a year and a half maybe look to get to 2,500 crores. So on the management side, senior management side, have there been any additions that you're making and plan to make going forward?
We had a CRO who joined, Mr. Raghavan, Chief Risk Officer. Other than that, I don't know. Of course, a lot of team members joined, not on a C-level position, other than Raghavan.
But yeah, we are looking at in terms of an HR perspective, also kind of moving from a regional management system to maybe a zonal kind of a management, wherein we kind of dissect the entire geographies that we work into various zones and kind of provide more bench strength in terms of the overall operations.
Right.
Mm-hmm. Okay. Thank you very much.
Thanks.
Thank you. The next question is from the line of Hiren Kumar Desai as an individual investor. Please go ahead.
Yeah. Sir, congratulations on a good set of numbers. The question is, in this inflationary situation, and one of the participants asked about FMCG sales being very low, and so some difficulty with that section of the society. So do we have a breakup of what portion of our loan is for business or livelihood earning or something like that, and what proportion is for consumption?
So technically, all of our loans in microfinance and MSME both are for income-generating activities. Which is not to say that once you give the money, whether some of it winds up to consumer, but largely speaking, all of our efforts is to make sure it's for some income-generating activity.
Okay. And the second question is, after the usage of this software and as we move forward, do we hope to see some operating leverage in terms of OPEX coming down as a percentage of assets or income, whichever way you look at?
Sir, that is always a hope, and as Jayendra Bhai would put it, that cost cutting and finding efficiency is always a constant endeavor. However, you will find us to be quite lean overall. How much extra lean that we can become, I think the idea is to always find a balance. If your goal is to become the leanest and the most cost-efficient company in the industry, you might get some good short-term results, but that means that you are not investing enough. Your people might get frustrated, your retention might suffer, and a lot of other things might happen. With the software, definitely we are expecting to see efficiency of the FOs increase in terms of the number of disbursements they can make. And largely speaking, the second biggest goal was to reduce the overall risk in terms of operations and in terms of credit risk to the customer. So those were the large two goals with the software implementation.
Last question, if I can sneak in, is while interest rates are rising, assuming that most of our customers borrow at a fairly high rate, how sensitive are they to the rate that we are charging? The question is, in the rising rate environment, have you correlated to some past cycles or something like that to say how it impacts our growth?
Surprisingly, sir, they are not at all sensitive to interest rates. And largely speaking, they are able to absorb 1 or 2% here and there without any problem, and without even, frankly speaking, noticing too much. Now, any large-scale increases like 4-5%, obviously it will be a problem. But generally speaking, for us, going from a weighted average cost of borrowing of 11.5 to 13 would be a huge problem because the ROA will reduce by 1.5%. For them, it will make a difference of 20-25 rupees in their EMIs, which most people don't notice or don't care enough about. all they care about is timely availability of funds in the least hassle, which causes them a least amount of disruption and hassles, if I can put it that way, and a good level of service.
Thank you. We take the next question as the last question from the line of Savi Jain from 2.2 Capital. As a follow-up question. Over to you.
Yeah, hi. Where does this equity take you in terms of, how many years of growth can be taken care of by this equity raise?
I mean, that's the million-dollar question. You have your own internal accruals. So depends on what kind of ROE we can generate and depends on what kind of ROA and internal accruals that we can get. If we are growing at our rate of ROE, then we never need to raise. We can grow indefinitely on our own internal accruals. But the base estimate is somewhere around 2,500 crores.
Yeah, I mean, basically this equity raise just kind of the 3 years of growth is and the leverage increase has been taken care of, and now you're at a level where it's a comfortable car. So at 30% growth rate and 30% ROE, you would not need to raise any equity.
Exactly. So, I mean, 30% ROE is difficult to maintain, and if you are growing at 40%, it will take us far. I don't think equity is a big concern for me at this point. It's not like this was just kind of a teaser round and then 6 months later I'll need to go back to the market again. So we should be, I mean, at the very least, we should be, given that there are no more surprises like COVID or anything like that, we should be good till at least 2,500 crores.
Great. That's it, sir. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to the management for the closing remarks. Thank you, and over to you.
Thank you, everyone, for joining. We hope that we've been able to answer all your queries. We look forward to the next interaction in the future. In case you require any further details, you can contact us directly or our investor relation teams. The contact information will be available on the presentation, which is on the company website and on the stock exchanges. Thank you again, and have a pleasant evening.
Thank you very much. Ladies and gentlemen, on behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.